Selling options is the closest thing to printing money. It's like a dividend on steroids. And while it does print money, it can also put you underwater very, very quickly, especially with massive downturns like we had over the last 10 days. We're down over double digits in just 10 days and over 20% year to date at the time of making these plays. That's a market correction and technically a bear market. Folks, I want to be as transparent as possible with you and show you how I print money, but also how I manage massive underwater positions in times like these. For this reason, I'll be showing you a mini series on how I'm managing a $1 million marker on 3 different stocks. And I'm massively underwater. The stocks are Sofi, Robinhood, and MSTU. If you're unfamiliar with MSTU, it's a leveraged fund on MSTR, aka a Bitcoin play. I'm doing one video each day. Yesterday we covered Sofi. If you missed that video, click on the link up above. Today we're diving into Robinhood, and tomorrow we're going to be doing MSTU. I have a massive $655,200 collateral marker on Sofi, $140,000 200 on Hood, and $255,100 on MSTU. That's north of $1 million that I'm managing successfully thus far in the worst of times over the last 3 months. And since I'm literally nobody to you and you're asking who is this phony talking to us, let me show you some receipts. On Sofi, I've got 468 contracts at 100 shares per contract at a $14 strike. That's $655,200. On Robinhood, I have 26 contracts at a $37 strike. That's $96,200. And another 10 contracts on Robinhood with a $44 strike. That's another $44,000 for a total of $140,200. On MSTU, I've got 200 contracts with a $2.50 strike, another 200 contracts with a $3.50 strike, and a much bigger 193 contracts at a $7 strike for a total of $255,000 and 100. This is real money, big money, and my goal is to share with you what I've learned as a pro. No flexing here whatsoever, just a really nice AP, just a real world example in a non-cherry pick market condition. Today's video is on Hood, and it's very, very different from yesterday's, which was on Sofi. I'm using a totally different technique called rolling out and down, which I'll show you today. This video is jam-packed with information, so follow the screens and all the arrows that I'm putting up. It's part of a 3-part mini-series. Each trade is unique to give you the best real-world insight, so check the playlist down below, Managing Underwater Options, and watch all 3 episodes. If you're new here, my name is Adam, and I retired in 2024 at the age of 41 years old. My retirement is built on a 3-part approach. Number 1, the multi-bagger for asset growth. Number 2, high dividend income for consistent cash flows to pay your bills. And number 3, options income to supercharge your passive income with covered calls and cash secured puts. I'm not a financial advisor. This is not advice, just me walking you through how I manage real world trades with real money. Today, I'm going to be diving into my $140,200 Hood position underwater in a bear market. 20% year to date at one point this year alone. Hood hit a low of 32.75 last week on April 8th. And I've got strikes for $38.50 at the time. Now it's $37, which I'll show you what I did, and $44. Most people would panic, but I'm cool as a cucumber using a technique called rolling and rolling out and down to manage this. I'll break it down with a focused lesson on my real trades. Also, I'm going to answer 2 viewers' Q&As that asked me specifically the questions that I'll be answering on today's video. And follow the screenshots as always, and the arrows. This is going to be loaded with value. Let's start with the basics for beginners. Because a bear market can feel scary, When you sell cash secured puts, you agree to buy a stock at a set price called the strike price by a certain date called the expiration date, getting a premium upfront like a juiced up dividend. If the stock stays above the strike price, the contract expires worthless and you keep all your cash. But if it drops below, like Hood did, you're underwater, meaning you might have to buy the shares at a price higher than the market is giving you. However, this is the key, you can manage this with rolling and wheeling. Rolling is when you close out a current contract and open up a new contract, usually a month out for me personally, could be different for other people, ideally for a net profit, which means you're actually making additional premium to your original play, buying time for the market to recover while collecting cash to wait. Wheeling is when you get assigned your shares, so you actually have to buy the shares, then you sell a covered call on the shares that you were assigned against them to generate even more premiums, cycling back to puts like a money wheel, hence the name, a wheel strategy. It's crucial to know these can get assigned at any time, even next week, a month early, if you're in the money. That means that if the strike price is above the current market price of the shares, anybody can call that in, the buyer of the contract. It's the buyer's choice, but in my personal experience, they're greedy and usually wait for the last few days of the expiration week. Know the risk and manage smartly. Now, let's talk about today's technique, rolling out and down for a cash secured put. Out means at a later expiration date, and down just means lowering your strike price. This is perfect when you're close to the strike price. It lets you collect even more premiums while reducing your cost basis and improving your odds of exiting the play profitably. Your actual cost basis isn't the strike price. I know it's counterintuitive. It's actually the strike price minus all of the premiums that you collected collectively. It's absolutely a game changer in a bear market like this because it's keeping your real risk lower than it looks. Rolling shines in corrections because volatility spikes, premium gets fatter when the stocks like Hood are bleeding. But timing matters. If the stock is 30% below your strike price, premiums dry up. Ideally, you want to roll within 20% of your strike price. 5 to 10% gets you similar premiums to your initial play, and under 5% actually is going to get you more premiums, as you'll see a little bit later in this video, than your initial play. You can't control flash crashes. You cannot control what's happening in the world. But here's the kicker. In those moments, volatility spikes, premiums jumps, and you can actually still roll to fight another day. Markets chop, bear markets have bullish rebounds, bull markets have bearish drops. As an option seller, these are prime times to roll and exit. Don't be greedy. It's scary to be underwater, but breathe, stay calm, drink some water, and go watch, because I'm proof you can roll in nasty times. Before driving into my Hood trades, let's address two awesome questions from yesterday's Sofi video first, which you should definitely be watching before watching the rest of this video. My man Tommy asked, didn't you buy to close those rolls for a loss? I replied, when you roll, you're buying to close out old contracts, often at a loss, and selling to open a new one. The new premiums offsets the old costs, lowering your cost basis while extending the trade. Tommy wanted the math, so I'll show it to you today in my Hood rolls. And the second question is from my man Woody. He said, great content, thank you. Question, do you ever take a less credit on the roll so that you can lower your strike? Say in this example, when you go another month out, would you switch to a 13 strike instead of $14 strike in my SoFi video and more or less break even on the roll? Or do you always stay at the same strike? What a great question. I said, yes, sir, watch tomorrow's Hood video. That's why I broke it into a series. That's exactly what I did on the Hood play, lowering from $38.50 to $36. Stay tuned, amazing question. And here are my examples. Let's get into my $140,200 Hood position. If you're not looking at the screen, now is a great time to start. Watch the arrows and follow along. This can save your trade one day if you're underwater. On March 3rd, I opened up 10 cash secured puts at a $44 strike, all expiring March 21st. I did one contract at $1.13 credit and the other 9 at $1.15 credit for a total credit of $11 and $48, about $1.15 per contract on average to make the math easier, putting up $44,000 of collateral. That's 10 contracts times 100 shares times 44 gives you $44,000 of collateral. If you're doing the math, that's about 2.61% return on my money for a 3-week play. Not bad. Hood was just under $47 then, so my strike felt safe. On March 19th, Hood was near $43 underwater, but close to my strike, a perfect spot for rolling. I rolled all 10 contracts to April 17th, same strike at $44, collecting a net credit of $1,749.12, about $1.75 a contract. That's 4% on my money, more than my initial play. And now here's the math Tommy asked for. I owed $368 per contract to close the old position, but the new contract paid $5.43. That nets me $1.75 per contract. 543 minus 368 equals 175. Covering the old premiums and pocketing the rest, lowering my cost basis, the total premiums then are $1.15 initially collected and $1.75 for the roll, total $2.90. So my cost basis at this particular point in time is actually $44 minus $2.90 or $41.10 if you had to buy the shares. I could have waited since I was neutral and about at my strike price, but I wanted more income, so I rolled at the opportunity. On March 27th, I opened 26 more contracts with a $38.50 strike expiring April 17th, collecting $2,262 or 83 cents per contract. Another 3-week play, collecting 2.1% of my money with $96,200 collateral. 26 contracts, 100 shares, $38.50 gets you $96,200. Hood was trading around mid $44, so I used a big cushion for a cash grab, avoiding greed. Fast forward to April 9th, last week, right before the melt up from $35 to $42 later that day, I rolled both positions for the 26 contracts at $38.50. I did a new technique that I haven't showed you yet called I rolled out and down to a $37 strike, expiring May 16th, collecting $1.05 per contract for a total of $2,730 total, or 2.83% on my money, more than my initial play. Hood was $35 at the time, so lowering the strike reduced my cost basis and my risk, giving me better odds to exit worthless. Total premiums for this was 83 cents plus $1.05, $1.88 total. Cost basis was $37 minus $188, $35.12. Remember, I rolled from $38.50 to $37 minus $1.88 that I collected gives you $35.12. I took the win to live and fight another day, especially with so many underwater plays. This out and down roll also answers the question previously from D. Carrick. But I also had 10 other contracts for $44, which I also rolled to May 16th, keeping the $44 strike, collecting another $1.45 per contract. If you're doing the math, I collected $1,450 on this roll, or 3.3% on my money. Total premiums collected, $1.15 for the initial play, $1.75 for the initial roll, $1.45 for this roll, totaling $4.35. My cost basis is now $44 minus the cumulative collected premium of $4.35, gives me $39.65 as my cost basis if I had to buy today. And if you're doing the math, that is a massive 9.9% return over the last 3 months. That's not bad. Here's where I stand. Across the total 36 contracts, I've collected $8,980 in premiums. That's $1,148, $1,749, $2,262, $2,730, $1,450, adjusting for rounding. That's a 6% return on $140,000, $200 collateral over the last 3 months, hitting well above my 2% target. That's my monthly goal, 2% or more, despite being in this bear market. Hood currently is trading at $44.56 today, April 15th, just above my $44 strike and well above my cost basis of $35.12 and $39.65, respectively, between the two contracts. I'm feeling very, very strong if it stays above 37 and 44 by May 16th. The contracts expire absolutely worthless, and I'm just going to keep my $89,080. Now, if these contracts don't expire worthless and they're above my cost basis, well, then I'm either going to be even Steven or winning a little bit, and I'll reevaluate. If not, I'll roll again or reel. I'm more confident here than with Sofi, but I prefer to exit the position all the same to free up my collateral. Given my many open plays, hence the out and down roll. This bear market is absolutely tough and it's absolutely relentless, up and down every single day like a roller coaster we go. I'm still banking premiums, rolling out and down, or just rolling out, buying time, lowering my strike, and boosting my odds of a win. Hood's a trading app king. I'd own it happily, and I do own it. I own shares and I own leap options on it. If assigned, I'd get those 3,600 shares at an effective price below my strikes, sell covered calls, start the wheel strategy. What's my goal? Keep all the premiums or buy low and profit on the rebound. Worst case, I'll hold the stock I believe in at a discount. Let's talk about a scenario. On May 16th, Hood is at $40, well below my $44 strike and my $37 strike respectively. I'd roll the $44 strike again, maybe out and down to $42, or I might let these contracts expire depending on my other positions. If I were to roll out and down, I would probably collect another $1.50 in premiums. My cost basis would then drop even further, and the markets are going to be up long term. Hood's got potential. Time is definitely my friend. Beginners, don't stress collateral. My 140,200 is backing my promise to buy if assigned. If I buy 3,600 shares, premiums mean I'm paying less, a big win. Pick stocks that you know cold, like Hood. And stay smart. Go for a 20 delta, 80% of your favorite trade, 2% monthly premiums, 4 to 6 weeks out. That's how you keep cool in a bear market, especially for beginners. This 140,000 trade shows how rolling out and down can turn a tough spot into a win. A correction like this tests your strategy, but volatility fuels your premiums. And rolling lets me capitalize while waiting for the turn. I'm crafting a win one premium at a time. Whether retired or working, this can work for you as it works for me. Start small, one contract on a stock you hold forever, and build from there. If I can do it, anyone can do it. I'm not a financial advisor. This is not financial advice. Definitely consult a financial advisor. Do your due diligence and do your own research. I'm just some guy sharing my own plays. So please don't take this as advice and seek professional help. Remember, the best way to get into cash secured puts or covered calls as a beginner is 20 delta, 80% in your favor, 2% in premiums per month, 46-week duration. And if you're too lazy or you don't want to start this or you're a little scared about selling covered calls and cash secured puts, click on the link up above. This is about a covered call ETF that pays you monthly dividends, 14% annually. Thank you. I'm out.